Mark David here, and today I have the opportunity to speak a little bit more about one of our innovative programs at CMG with one of our experts, Dave Herbst, who is going to share with us a little bit more about how some of our clients across the country are maximizing this opportunity with this innovative loan program. So, Dave, I'd like to have you share a few words with us about this program that more and more people are hearing about, this all-in-one. So tell us a little bit more about this.
Yeah, I appreciate it, Mark, very much. You're right. I think that a lot of people are beginning to hear about the program more and more these days. I think it's probably pretty important to actually mention that it's not a new product, even though it may be the first time for a lot of people that are hearing about it now. Coming up in June, it'll be 16 years that we've had the program available. And you're right, we do brand it the all-in-one loan product. And essentially what it is it's a mortgage product that's designed to help people pay down their mortgage debt faster than a conventional mortgage. And the benefit there is that it helps people avoid a tremendous amount of mortgage interest payments that would normally come with a conventional loan. It does it safely. It does it very effectively. It does it without changing or requiring a change to somebody's lifestyle or their budget. And I think also most importantly, it doesn't require you to chase around interest rates, to achieve savings. And it's engineered, very differently than conventional mortgages. Essentially what it is it's a first lien position, 30-year draw home equity line of credit that you use to finance your property, whether that's through a mortgage refinance or a home purchase. It could be applied to a primary residence, a second home, and an investment property. But probably the most unique feature about this home equity line of credit is that it comes embedded with what's called a zero balance sweep checking account. So it's a personal checking account or personal banking merged with your mortgage. You literally deposit your income checks directly into your loan and pay your bills from your loan. And it creates this interactivity, this real relationship between money and the mortgage debt to help reduce the mortgage debt and the interest payments with it over time more rapidly.
I've actually heard from a couple of individuals where they'll hear a little bit about our program and then they'll say, "Oh, I know about that. That's paying an extra payment per year, like a biweekly payment." How would you explain that to those individuals? How that's a lot different?
For sure. I love the fact that, that people ask that question and that there are other alternatives to help people pay down their mortgage balance faster as well, like a biweekly payment program. And there's other things that have been offered out there, strategies and systems, even software and fintech has been involved with helping people kind of, manage money and chunk away at your mortgage debt by using, some other line of credit or something, right? Very, very kind of hands-on systems and strategies. The benefit of a biweekly payment program is that, yes, you accelerate your mortgage payoff. Generally speaking, it'll shed about 7 years off of payoff timing of your mortgage. The downside to that, you're still in debt potentially for 22, 23 years of your life. About 9 out of 10 of Americans use a 30-year loan for financing. So a biweekly payment is good because it speeds that process up and you save some interest along the way. Doesn't really disrupt your lifestyle. You might have to, maybe cut back here and there because you're adding an extra payment towards your loan in a biweekly fashion. But I would argue that it doesn't speed it up enough. The benefit, the real advantage of the all-in-one loan and the merging of your personal banking with the mortgage itself is that we all use a checking account, and our checking accounts tend to be where we flow our income into and pay our bills from. So imagine your checking account being embedded into your mortgage. The day that you get paid using the all-in-one loan and you make a deposit into the checking account, your principal balance drops by that same amount that day in its entirety. It uses 100% of the deposits, 100% of the money you have on hand right now today to reduce your balance and therefore your exposure to mortgage interest that month. That's the big difference. It's using everything you have. It's making your money go further and all of it, not just a little bit of it, to help you, speed that process up even more aggressively.
If I heard you correctly before, the other huge difference is going to be you get that availability of what you pay down on the all-in-one compared to if you're just simply throwing chunks of money that are locking that equity up in your house. on a
Totally.
traditional mortgage, right?
Yeah,
Is that
totally.
correct?
Totally. The biweekly is good, but you're number one, you're only putting a little bit towards it. People are generally reluctant to put more than they have to towards their mortgage to pay it down for only one reason, because their money is not liquid, right? When you put extra towards your principal balance on a traditional loan, even in a biweekly program, your money's locked up in the mortgage. You'd have to go refinance, do a cash out refi, or maybe go get a second lien on your home to gain access to any of those funds back out. And the all-in-one loan solves those issues. It keeps your money liquid. What you put into it today is liquid for you to pull out and accessible 24/7 over the entire 30-year term. So it makes it very safe and effective to actually apply extra funds that you have in your possession right now and you don't need for any other expenses towards your mortgage balance, so you can actually save interest that month.
Can you share with our viewers, Dave, what are some typical results we've seen over time? I mean, this isn't a new program, of course, to also clarify. This has been around for a while. What have we seen on average with different results?
Again, it can be used for really, not just to finance a new home purchase, but also to refinance out, of a current mortgage. What we typically see, our typical customer, are those folks who, have really kind of fallen into the trap over time, and really recycled their mortgage debt repeatedly, it seems. And there's a variety of reasons why, that seems necessary for a lot of Americans, right, to do. There's chasing interest rates. They're bringing down their mortgage payments. Maybe you need some cash out. You want to renovate a home. Maybe you want to buy another home. So it seems that because of the rigidity factor of the types of loans that the industry has, put out there and made available for so long, it really forces people to have to recycle their mortgage debt over and over again. Our typical customer is somebody who really is kind of sick of that cycle. They tend to be somewhere around in their late 40s, early 50s, typically on average. And that makes sense. The vast majority of mortgage debt is actually owed by the Gen Xer population and then the baby boom population. These are folks that tend to look at their circumstances. They want to retire someday. Maybe having their home paid off by that point would make a lot of sense to them. Maybe it'd be a lot harder to retire on time or, comfortably if you still owe a mortgage. So we tend to find that people gravitate towards this loan because it really helps them achieve those goals. The performance of the product is just unmatched. The average customer pays down at a pace of about 13.4% of their principal balance annually. So imagine reducing their balance annually by that amount, just being eliminated, because it's accelerating. You're compounding your savings and saving so much that your balance just continues to fall pretty rapidly. So, that would equate into probably about a 9 to 10 year payoff. So that it changes the trajectory of your pay down. That's not to say though, Mark, as you mentioned here earlier, that, life, I think the one thing certain about life is that there's a lot of uncertainty, that there's a lot of things around the corner that we haven't even thought of yet that may impact us financially. Who would have thought of COVID, right? As a good example, right? And that's impacted a lot of Americans. Well, it's a line of credit. It allows people to flexibly maneuver, through those financially challenging times. So you may be on pace to pay down your home in 8 or 9 years, but then you come across either an opportunity or even a financial challenge and you need to pull some money out of your home. Well, you don't have to go refinance to go do that. So performance-wise, we also see a decent population of our portfolio sometimes need to do that, where you see the balance driving down rapidly, and then you see that there's some expenses that they're paying, that they're funding, maybe renovation on their property. Maybe they're putting a down payment on a new property, or maybe they're just getting through some financially challenging times. But it's a high performing loan. To date, we have 0 reported losses, 0 reported delinquencies or defaults since 2005. So just consider what we've seen since 2005 in the economy, right? And so it's very high performing, very safe for us as well as the customer.
You kind of lightly touched on some of the categories of homes or real estate that this can be used into, but can you go into a little more in detail of what does somebody need to expect if they were purchasing, what type of limits they need to have as far as down payment or equity position to qualify for this? And then also, I guess, to elaborate a little bit more on it isn't for everybody, right? I mean, clearly
Yeah.
a message too there, right?
Yeah. We sort of have a mantra, internally here, and that mantra really goes like this. Although this may not be for everybody, we truly do believe that everybody should know about it. It's unique. It represents innovation in the lending industry. It changes the way money is actually applied to the mortgage debt so that it could, impact and financially improve, each customer's life. And if you think about it, it's sort of weird how, we know as fiduciaries in the industry that each of our customers is very different from one another, right? So a tremendous amount of similarities, but there's all, everybody is a little bit different. I'm a little bit different from my neighbor, right? Different levels of means or income coming in, financial challenges and obligations and goals that I want to meet. I always kind of find it strange how our industry has felt comfortable delivering really the same exact product to everybody, even though they're different. We may deliver a slightly different interest rate here and there, but the terms of the loan are identical, right? They're manufactured the exact same way. The beauty about the all-in-one loan is that for customers, they get to tailor, really customize the results of it based on their use of it. It's a true financial tool for them to help plan through their housing years and their housing goals, their payoff goals, and again, fund any other financial needs that they need to fund along the way. So although it may not be right for everybody, the right person is a positive cash flow household. People that don't tend to spend more than they make. I think you can't get very far in life if you live that way anyway, right? Let alone qualify for a mortgage. But it certainly helps those that spend, well within their means, tend to leave some residual cash, in a savings account or checking account so that they don't overdraft. Those that tend to be good savers and are disciplined that way. This is a phenomenal product. It puts all that money to work and keeps it liquid safely for future use. So some of the program guidelines I can just highlight here really quickly. Again, for a primary residence, we can actually lend up to 90% loan to value. And that tends to be at a dollar amount limit of about $850,000. So, and that's reserved for a purchase or what's called a rate and term refinance. If we need to go higher than that in loan amount for a primary residence, we can go to 85% or 15% down on a purchase to $1 million. If somebody has more than 15% to put down, we could actually go to $1.5 million up to 80% loan to value. And then there's a step down all the way up to $2 million. So generally 70% loan to value up to $2 million. And that could be a purchase, a rate and term refinance, or a cash out refinance. And then for non-owner occupied, we will fund a purchase up to $1 million and or a rate and term refinance up to $1 million. And that our limit is 75% loan to value. For a cash out refinance on an investment property, our limit is 70% to $1 million. So we'll still go to $1 million, but there needs to be at least 30% equity in the property in order to achieve a cash out refinance transaction. The second home guideline limits tend to follow the primary residence, with the exception of loan to values above 80%. So we generally get capped on second homes to 80% to $1 million, 75% to $1.5 million, and 70% to $2 million. So it's a lot of information there, but again, every single scenario is slightly different, but those are the general terms of our guidelines.
You kind of lately mentioned before regarding this concept of pairing the loan with this checking account or sweep account, maybe we could call it.
Yeah.
And I guess I'm familiar somewhat, but if you could elaborate more on that whole concept, how in itself is so innovative as far as kind of what I would say probably what the reverse of our industry as far as how that applies towards the loan balance first and then interest, or can you talk a little bit more about that?
100%. I mean, you're dead on. This is really where the innovation really lies within the product itself. It's a zero balance sweep checking account. I know that's new terminology, so let me repeat it really quickly. Zero balance sweep checking account. The zero balance means that the checking account is actually engineered not to keep a balance in it, right? And I know that's kind of hard to digest for a moment, but let it sink in. Really consider why that makes a lot of sense. A traditional checking account doesn't pay us anything really in return, right? we're not really earning a lot of interest on the dollars that we flow through our traditional checking accounts. So, outside of having secured access to our own money, it begs to kind of, you kind of start to wonder, like, what good is this checking account? What if that checking account actually automatically swept my money into something that benefited me, that gave me something tangible in return, right? And why is that a good idea? Because checking accounts are, again, where everybody tends to manage their income. It's the first stopping place for your money before you need to go spend it or you invest it, right? Or you move it to another savings account or something. It's certainly where you pay your mortgage bill from, your mortgage payments from, right? But the reality is that we don't spend all of our income on one single day each month. Money tends to kind of loiter around, for lack of a better way to put it. It kind of lingers around for days on end until it's spent. You might have a cell phone bill that's not due today. Maybe it's due in 10 days, but you've already earned the money you're going to use to pay that bill. Maybe the mortgage payment that's going to come up on March 1st. You've already earned the money you're going to use for that mortgage payment. So where is it residing? Again, typically in a checking account, earning you no interest at all. And again, there's a lot of money. It's a high volume of money over time. Think about it. Just consider the amount of money that you may deposit in just 5 or 10 years. And that amount of money dwarfs what most people owe on their mortgage currently. And so, the beauty of the sweep, the zero balance sweep checking account, the innovative part of the all-in-one loan is that it automatically will digitally transfer the money out of the checking account for the customer the day that you make that deposit, and it's going to apply it into the home equity line of credit, which serves as your mortgage. And when it hits the home equity line of credit, the same day, it pays down the principal balance in its entirety by the amount that you deposited that day. If I deposit $1 today into my all-in-one loan checking account, the principal balance of my all-in-one loan HELOC drops by $1. Same occurs if I deposit $10,000. My principal balance on my mortgage, my HELOC, drops by $10,000. The interest recomputes nightly on that unpaid principal balance. So as long as I have idle cash, that's not needing to be spent today, I've now effectively used money I already had through an instrument I already am proficient at using, my checking account, to lower my daily principal balance of my mortgage automatically without me lifting a finger, which now reduces the amount of interest that's going to compute that day on the mortgage. If I can do that every day throughout the month, guess what? I just reduced the amount of interest I'm going to owe at the end of the month. And that's the other thing I think you're driving at too here, Mark, is that the interest on this loan is not forward. It's not advanced amortized. It's not an amortized loan. It's recomputing interest nightly at midnight. So it's re-amortizing in a sense every 24 hours throughout the entire term of the loan. The only product in America that does that. As you know, on a traditional mortgage, your interest costs are predetermined. It's part of the contract. And most of that interest is paid for up front. A lot of people think that their low interest rate, fixed rate mortgage is really the best thing out there. In a lot of cases, it is. It really serves that type of customer that really needs that may be closer to living paycheck to paycheck. Maybe they're just kind of getting going in life, financially speaking, really trying to establish themselves. For those Americans out there that are cash flow positive, tend to have a bit more discipline. They're well on their way and much more disciplined or established with their finances. You really have to ask, is that structure benefiting them as much as an all-in-one loan could, where all that money is going to principal? It's really the only loan in America that I know of where we could proudly say it's 100% principal paid first, all throughout the loan's term. Anything I put towards it goes to principal, never interest. Interest is computed nightly, totaled up once the month is ended. And then it's not due until 21 days later into the new month. So it's interest paid for in arrears versus being, paid for in advance. One last comment on this topic. Many people may not realize it, but about nearly 50% of the total interest on a traditional mortgage, like a 30-year loan, is paid for in the first 10 years. So think about the consumption of your hard-earned money, going towards interest, and your balance is barely coming down. So, mortgages tend to be this financial impediment, this obstruction, this barrier to rapidly reducing, the balance and the interest expense, where this one's engineered to do that for you safely and comfortably and naturally.
Wow. Yeah, that is definitely the key element there. And I mean, I think too, with the concept of changing this, innovation to apply to a checking account and your home loan and having those results is very powerful. But I think even more powerful to visualize would be if somebody eliminated their mortgage debt almost, you said on average, potentially like 2 decades faster.
Yeah.
Imagine then, let's say it's a $1,200 a month amount that they're paying on their mortgage that now could be invested for 20
Yeah.
years versus going out to the banking system, right?
Perfectly put. That's the opportunity cost or gain, as I like to say. What you gain by freeing your money up from mortgage payments. If you could save 2 decades from having to pay on a mortgage because you drove your balance to zero, number one, the all-in-one loan home equity line of credit remains open. It doesn't close automatically. You could still use it freely and pull money out over the remaining 20 years in this example. Additionally, the money that you would normally have had to spend on a mortgage payment that you were keeping in the all-in-one loan to drive the principal balance down faster is now free. That's part of your income that you can now begin to use to invest more aggressively earlier in your life. So, just look at an annual compound, calculator, and you could realize how fast, you could really create millions of dollars in personal wealth by getting rid of debt faster. And then, working with potentially a financial advisor and really, growing your wealth, the wealth side of your balance sheet. It makes it easier to do because you don't have this big barrier in your way. I think, Mark, that's one of the biggest, benefits of the loan product is that the opportunity gain that you get by using this and by getting rid of the debt faster. And I don't think that is shared enough, honestly. So I'm glad you brought it up.
Dave, we really appreciate you sharing some time with us here today about the all-in-one innovative loan solution here that we offer at CMG. And we are more than happy to answer any questions for any of the viewers that want to know more about the all-in-one program and have us do a simulation for them. We can do that very easily by contacting myself directly at 262-644-0656 or the information that we have here listed below me. And again, thank you for spending some time here with us and learning more about this program.
Thanks for having me, Mark. I appreciate it.